Hello, and thank you for joining me today. My name is Wesley Boudreau, one of the financial advisors here at the Retirement Group. I'm going to give you a real quick update on the interest rate environment and how it's affecting the lump sum calculations with the ExxonMobil pension plan. Now, for many of you, the annuity may be the best choice for you, but for others, you may be interested in the lump sums, especially given the nature of the interest rates right now, generating some of the highest lump sums we've seen in the history of the company. So before we get started, if you have any specific questions or want to run an updated cash flow analysis or start a cash flow analysis so you can compare both those options side by side, give us a call at 1-800-900-5867. Now I'm going to give you a real quick background of the pension plan. I'm not going to dig into a lot of details because we covered that in the pension webinar. And then we'll talk about the interest rates and what's happened recently to affect those lump sums. Now, with ExxonMobil, as you transition to retirement, there's really three sources of income you're going to be looking at to cover yourself throughout retirement. One of those is going to be Social Security, in which case you have the option of taking it as early as age 62 or deferring all the way out to age 70 if you want a higher income from it. Now, we can run a Social Security analysis for you if you have any questions about that or want to see all the different claiming strategies available to you. The other option is going to be, or in addition to that, you have your 401k, which you've built up over time by making contributions yourself as well as Exxon into the plan. Now, once you retire, you've got that certain amount that you have the option of keeping in the 401k plan or rolling over to an IRA, and it's your responsibility to take distributions in order to generate income on your own or work with a company like the Retirement Group to help you do so. Now, one of the key sources of income that's unique to Exxon is the pension plan. Now, the pension plan is actually calculated a few different ways, but it's a defined benefit plan. And what that means is the actual benefit that you're going to get is defined, not the amount that's going in. So it's Exxon who's on the hook for giving you the payments based upon that calculation they use in order to generate that single life annuity. So with pension plans, the way that it's structured is there's a calculation, and we're not going to go into detail on it today, but there's a calculation using your years of service and your final average pay to determine what is a single life annuity or a monthly income that Exxon needs to give you for the rest of your life. Now, from that point, you've got the option of different choices beyond the single life annuity, but they use that specific amount to calculate everything else. So other choices could be a joint survivor annuity for you and a spouse. It could be a period certain if you want to add a 10, 15, or 20 year certain period on there so you make sure you're getting your money back out of it. Or you can take a lump sum, which is what we're going to go over today, or you can do a combination of any of those, whether it be 75, 50%, or 25% between the annuity or the lump sum. Now, the lump sum is calculated based upon interest rates, and so what happens is when interest rates are low, the lump sum is going to be higher. So what they do is they look at your specific situation. Let's say if you go through that pension calculation and you determine your single life annuity may be $3,000 a month for the rest of your life. Now they're going to take a look at what your age is and your life expectancy and figure out, okay, how much do we have to give him or her in order for them to try and actually recreate that $3,000 paycheck yourself. So if interest rates have gone down, then that means they have to give you more money to try and generate that same $3,000 for your income annuity. So what we've seen is interest rates have been on the decline, and they may or may not be bottoming out here pretty soon, so we may start to see those move up again. Now, depending upon how long you've worked with the company, there are two different interest rate scenarios you could be looking at. For older employees who have been there for over 23 years and are at least 63 years old by the end of this year, they would be grandfathered, and you're going to be looking at using the GAT rate, which is the 30-year Treasury multiplied by 95%, looking at averages of that. So that's going to generate a lower interest rate, which would generate a higher lump sum. Now, if you're not grandfathered, then you're going to be looking at the newer pension segment rates, which are corporate bond rates, broken up in 1, 2, and 3 segments in order to generate what your actual calculation would be for your life expectancy. So I'll go through those in just a moment. But again, to kind of dig into all the different choices you have, there's a lot of confusing options when you look at the combination of things. So if you have not run a cash flow analysis at all with us, or you haven't run one in the last year or so, again, give me a call and we can actually update that or start that process for you so you can see all those choices side by side. Look at your desired retirement date. You may have 2 or 3 choices of retirement dates. you may want to look at the lump sum or the annuity or a combination, 50-50, 75-20, whatever it may be. But if you get to the interest rates, as we talked about, this is what you're going to see the correlation being. As interest rates go up, your lump sum is going to come down. We're not in that environment right now, but we could be soon. We're in the opposite. Interest rates have been coming down over the last year, which is driving lump sums up. So based upon those calculations, and we look at this time last year, let's take a look at the at those grandfather employees right now. Look at the GAT rate. If we go back a year and we look at Q2 or Q3 for 2019, the GAT rate was at 3%. So if we fast forward to now, if you're going to retire right now in the second quarter of 2020, that GAT rate has dropped 1% all the way down to 2%. If you were to wait until third quarter, it drops again down to 1.75%. So what does that mean to you? A 1% drop, which is what we're seeing from last year to now, is going to, generally speaking, depending upon your age, going to be anywhere from an 8 to a 12% change within your lump sum. So for simple terms, that 1% equals about 10%. So that change of 1.25 means about a 12% change. And we got a few clients we're working with right now who we've been telling them to hold off for the last year because of the decline in interest rates, and maybe looking at making that decision here in the next few quarters of retirement, because they've actually seen a raise anywhere from $100,000 for a few of them to as high as about $225,000 for one of them. Now everybody's going to be a little bit different, but let's take that into account. Let's say if you have a lump sum that was about $1 million this time last year, that means if you were to retire here in the third quarter of this year, it could be $125,000 higher or so. Now on the flip side, if and when interest rates start to normalize and come back up, that $1.25 million in that example could start to come back down to that $1 million, or maybe go below that, depending upon interest rates. So if you were looking at retiring, in 3 to 5 years or so, there's really not much you want to look at or change, but we can still update the review for you. But if you're thinking about retiring in the next year or two, I strongly recommend we update those reviews so you can see quarter to quarter what your options are. Now going back to that grandfather rate we said is 1.75% here for the third quarter of 2020. We won't know until the end of June what it's going to be for the fourth quarter, but so far through the first 2 weeks of April, it's trending downward where it could be as low as 1.25% or 1.5%, so we could go lower. So again, we just want to keep an eye on that. Now, as I mentioned, for those of you that are not grandfathered, you're under what are called the segment rates, and those are tied towards corporate bonds, and there's 3 segments. There's the first segment, which covers the first 5 years of retirement, the midterm second segment, which covers the next 15 years, and the third segment, which covers years 20 and beyond. Now, if we go back again a year or so, and we look at the second quarter of 2019, those rates were 3.4, 4.39, and 4.79. Now, for the sake of this, generally speaking, there's more weight given to the midterm segment. So we look at that 4.39 figure, and if we fast forward to the new rates we just got recently for the third quarter of 2020, that's come from 4.39 all the way down to 2.9%. So we're talking about a 1.5% change, which means we're looking at about a 15% change in most lump sums over the last year or so. So that's even more dramatic than we've seen in some of the grandfathered employees. So again, it's very important that if you were leaning towards a lump sum, or at least just wanted to review the options, that you do give us a call to take a look at this, so that we can update those figures for you and let you know where you stand. And so if and when we see the interest rates start to turn, you're ahead of the game and you know what your choices are and what your options are. But again, at the end of the day, for some of you, the annuity may make the most sense, so we'll review that for you as well. And also, just because the lump sum may be declining, that's not necessarily a reason to give up a paycheck. But if we do see a decline, it could mean you start to work for less than 100% of your income. So again, feel free to give us a call with any questions at 1-800-900-5867. And don't forget to visit us on our blog or at theretirementgroup.com and sign up for any of our additional webinars and the seminars once we have those going again. But otherwise, we'll give you an update in about a quarter, and I hope everybody has a great day.